Ray, in terms of just bottom lining it, for those in the audience this morning that beyond thinking about buying your book are thinking about whether they should be invested in the market, putting more money in the market, and I'm thinking about equities right now, taking money out of the market, how do you value this market today?
I think that just the way you said it is going to be a fool's journey to say, here's the stock market, and I'm going to time the movement into the market. I'm going to time the movement out of the market. Okay, you know what that means? Okay, you're going to guess what the next variant move is and what the next other thing is. A lot of things depend on a lot of other things, and the world and everything readjusts. What has to happen, I think, is investors, most importantly, have to realize two things. First, that cash is not a safe investment, is not a safe place, because it will be taxed by inflation. There will not be an interest rate that will anywhere near compensate. And it seems good because it's not volatile, but you're paying a tax of a few percent a year on that. So A, stay out of that. And then B, know how to balance a portfolio, because the way portfolios work, it's almost like for some part, something happens, another thing happens. In other words, what you can see in the markets today is that, let's say, when equities go down because growth expectations falter and there's a greater likelihood of easing, then you see the bond market go up. Or when you see other markets, gold, you're seeing. Watch the market action on every day, and you could see those relationships. But wealth is not destroyed as much as it is transferred. And if you know how to balance those investments, we do it in what we call an all-weather portfolio. But if you know how to balance those investments, that's the most important thing. Be in a safe, well-balanced portfolio. You can reduce your risk without reducing your return, and you will not market time this, because even if you were a great market timer, the things that are happening can change the world, so it changes what should be priced into the markets.
Hey, Ray, one of the things you do write about is China. Some would argue that you have a generous or more sympathetic view to China than perhaps some of the most hawks, if you will, about China. But you think that there's sort of an inevitability to the transfer of wealth of sorts.
Well, okay, two things. China, transfer of wealth. I just know China very well, and I come as a perspective, with a perspective as an investor. I've been going there since 1984. I know leaders, and I know how they're thinking, and I know the moves that they're making in a detailed way. And I'm just trying to share what that perspective is, because I think a lot of people make stereotypical moves. And I think you have to really understand. First thing you have to understand, because it has been a remarkably successful place. Since I started going there in 1984, per capita has increased by 26 times and so on. So to not understand it or to approach it with a great bias is a great disservice. Okay, in terms of the element of, let's say, a transfer of wealth, or let's call it common prosperity. Yes, there's a world, in this world right now, there's a move to common prosperity. I think that that move, what does it mean at a technical level? That's not take your money away. But here, I would say what are called progressives here are much more left than what we would call progressives or whatever the Chinese policies are doing. But yes, worldwide, there has to be common prosperity, or let's call it broad prosperity. And the question is whether that's going to come about by productivity or not. It doesn't mean that you're going to have like a communism that's going to take all of that. There's going to be a lot of productivity in China. And so, again, diversifying the portfolio. You look at the United States elsewhere, you have to diversify.